Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with another episode of the Coffee Break Sessions. I'm here again with Paul Galloway. Paul, welcome back to the show.
Yeah, thanks, John.
So today we're going to talk about yield to maturity. What is yield to maturity and why is it important?
Yield to maturity is a return an investor will get on an investment in a bond over the total life of that investment. So meaning up to when it matures. It is based on current market prices and the bond's interest rate at issuance, which is your coupon rate. Since interest rates move daily, this means that the price or the value of the bond also moves. So there are a couple important factors to investors when it comes to these interest rates. And you want to make sure that you understand, like on the counterparty side, big risks associated with default or that a bond is called if there's a call feature in the bond.
Okay, and what's the difference between yield to maturity and current yield?
Yeah, so the current yield is a return an investor can expect to receive on a bond in the market today if you hold it for 1 year. So it's a short-term investment view, where the yield to maturity is a longer-term view. It goes all the way to the point where the bond is matured. That could be 10, 15, 20 years, or however long the bond is out for issuance.
How can an investor use yield to maturity to make investment decisions?
When you see a higher yield to maturity, that typically indicates that the investment is less sensitive to interest rate risks. As interest rates move, the value of that particular investment doesn't move a lot. So it's a better expected return, or it's considered to be more stable.
Okay. And what are the risks in relying on yield to maturity, or are there any risks?
Yeah, there are risks associated with utilizing yield to maturity. The basis of yield to maturity is that you're holding that investment until the day that the company has agreed to pay back the principal of the bond. So some of the common risks associated with utilizing or making an investment in bonds and utilizing yield to maturity is that there's reinvestment risk. This means that it's assumed that the investor is able to take those cash flows that come from that bond and reinvest them at the same yield as the yield to maturity. That may not be the case. The other piece is interest rates. Interest rates move daily. This means that over time, the yield to maturity is also moving. So what you calculate today, which a component of the calculation of yield to maturity includes time. So you've got current price and you've got time that have an impact on yield to maturity. The other piece is the counterparty risk I mentioned earlier, which would be like default, meaning that the investor buys a bond from Company A. Company A isn't able to make that payment at maturity or able to make their interest payments. So there's a risk that the cash flows are disrupted or you don't even get the cash flows. Another one that's out there is when a bond has a call feature. And so bonds with call features mean that the bond can be called early. An example of that would be when interest rates are falling and a company, let's say a company's paying 8% on their bond, interest rates are falling, they call the bond and they reissue a new bond at a lower interest rate, let's say 6%. That's good for the company that issued the bond. It's not good for the investor because the investor has to now reinvest his cash. So he's not going to get that, let's say 8% coupon, he's going to get a 6% coupon out in the market unless he's able to find a comparable investment out there, unlikely in a falling interest rate environment.
Anything else you want to add about yield to maturity?
I don't think so. I think we didn't go through an example of calculating yield to maturity, which is good because There's a lot of components to it. But when it comes to the investment side of things, it's really important that treasurers understand when they make that investment, they know what the underlying aspects of that are and who the counterparty is. You have to do your due diligence. You need to know that there is counterparty risk out there. You need to understand the risk of movement in interest rates. These things I think are really important, and know whether there is call feature tied to that bond. So you need to understand what's in that particular investment.
Well, thanks for sharing your insights.
Thank you.
And to our listeners, remember to tune back every first and third Thursday of the month for another episode of the Coffee Break Session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.